Dividend stocks are magical. You buy a stock and the company pays you for holding that stock. So why doesn't everyone just invest in dividend stocks and just leave it at that? Well, because the short answer is that they have a few drawbacks to them. And in today's video, we're going to be going over things you should look at if you're considering investing in dividend stocks. If you like investing in dividend stocks, drop a like on this video and let us know what your favorite dividend stock is. I'm going to leave a comment down there as well as to what some of my favorite dividend stocks are. So if you want to check that out, look at the comment section and leave a comment as well. So quickly, Dividends 101 here for beginners. A dividend is a payment that a company makes to its shareholders as kind of a thank you for holding their stock. Dividends can range from somewhere like a 1% yield, which means that if you had $100 in the stock and they're paying a 1% yield, they would pay you $1 as a dividend. And sometimes you'll see high yielding stocks that give you a yield of over 15%. But what you need to know is that you should not base a dividend investment solely on what the dividend yield is today. There's a few other factors that you need to understand to actually see if that dividend is sustainable. Remember, a company can cut their dividend at any time without letting shareholders know prior. So that's something you need to consider and be aware of before investing in these stocks. So the first question I would ask myself if I was investing in a dividend stock is, how is the company doing from a financial standpoint? Remember, dividends are paid directly from the company, and this means that they're actually taking a portion of their profits or their cash and paying out dividends with that. And naturally, as a result, this means that there's going to be less income shown on the balance sheet for the company. So the first thing you should check when looking at a dividend stock is how much cash and debt does this company have on their balance sheet? If that company has massive debt and not too much cash on their balance sheet, more likely than not, that dividend is going to get cut in the near future. And guess what? If and when that dividend does get cut, that stock is going to take a massive hit. The reason is because a lot of the investors in that stock are typically in there for the dividends. And if the company cuts back that dividend or stops paying a dividend altogether, a lot of those investors are not going to want to hold that anymore because they're not getting what they came for, which is dividends from that stock. A perfect recent example of this is Kraft Heinz. They recently announced that they're going to be cutting their dividend. And of course, they also had some accounting issues. But you can see what happened to the stock here after they announced that. It plunged 20% the next day, and this is not uncommon when looking at stocks that cut their dividends. So bottom line here is keep this in mind. If you do choose to invest in a dividend stock, make sure to look at their balance sheet and make sure that they have enough cash on hand if times do get tough, so that they can at least maintain that dividend and not cut back on it. The second question you want to ask yourself is, what is the payout ratio? So payout ratio, simply put, is the percentage that the company is paying out from their income towards dividends. And this really tells us how sustainable a dividend is. And typically what you want to look for is an average payout of less than 50%, because that means that the company still has a lot of cash that they're keeping for investing in the company and growing the business. And it also means that there's potential that they'll be increasing that dividend over time as well. If you see payout ratios from a company on average that's over 100% or more, that should be a huge red flag for you, because that means that the company is actually paying out more than they're earning, which means more likely than not, they're going to be cutting back on that dividend very soon or at some point, which again will spook investors. So to check the payout ratio for a company for their dividends, you can go to your favorite website like FinWiz or TipRanks, and you'll typically find that information readily available there. Now keep in mind, from these websites, these numbers are typically over the last 12 months, the average over the last 12 months. So when you see a payout ratio of say 20%, that means that the company has paid out an average 20% of their income over the last 12 months. So in this example here, we can see that Starbucks is actually paying out on average 58% of their net income to dividends in the last year. So at this point, you need to make a decision if that's sustainable or not. In my opinion, anything under 70% is acceptable, with 70% being the absolute max where I would actually consider investing in a stock if that's how high the payout ratio is. And of course, the lower the payout ratio, the better it is as an investor. So if you look at a company like Apple, for example, you can see that they have a payout ratio currently of 23%. And now you can understand why investors are so excited about the future dividend potential from a company like Apple, because there's just so much more room to grow for Apple. They can even double their dividend easily and still be well under a 50% payout ratio. The third thing that you should take into account when investing in a dividend stock is to see how long the company has been paying out a dividend for. If the company is a dividend aristocrat, meaning that they've been increasing their dividend and paying out a dividend for at least 25 consecutive years, then you can kind of rest assured that this company is going to want to sustain that record, and they are a pretty solid company for dividends. However, sometimes you may come across a company that's paying out a very high dividend with a very low payout ratio, and you may kind of think, okay, this is kind of a no-brainer. They have a low payout ratio, dividend yield is good, I'm going to invest in this company. But in reality, you should be very cautious of this, because if they've only been paying out a dividend for a couple of years, we don't know if that dividend is actually going to be sustainable over the long term. And more often than not, if they start off at a very high dividend yield, the dividend may not actually grow much over the next few years and may actually start getting scaled back, in fact. But when you see a stock like Pepsi, for example, you can see that they've been raising their dividends consistently for the past 47 years with a low payout ratio. So you can kind of rest assured that a company like this has their financials in check, and they will more likely than not continue paying out this growing dividend year over year to maintain their status as a dividend aristocrat. And this kind of brings us to our fourth point, which is, has the company been consistently growing their dividend year over year? So there are a lot of companies that pay out a dividend, but there are less number of companies that actually grow that dividend consistently year over year. So although company A may be paying out a higher dividend than company B, if company A does not grow their dividend year over year, but company B does, over the long term, you may actually end up losing out here, because the potential growth for that company that's raising the dividends every year could be much higher than that company that just keeps dividends stagnant year over year. So if you look at a company like Boeing, for example, you can see that even though they've been paying out a dividend for only 7 years now, they grow that dividend on average by 27% in the last 5 years and 23% in the last 3 years. So here you're getting a company that's growing their dividends at a 20% plus clip, meaning that if you buy today and this increase continues, your yield on cost will be much higher every time they bump up that dividend. So really the bottom line for this point is that it's very beneficial, and you ideally want to hold stocks that not only pay out a good dividend, but have a history of increasing that dividend every single year as well. Now the fifth point, which is kind of a personal preference, not a lot of dividend investors care too much about this, which is why I kind of listed it as the fifth point. It's something that I look at personally, and that is, what is the potential for the stock price to actually grow over the long term as well? So like I said, this is a personal preference, and I'm personally not going to invest in a company regardless of their dividend if I don't see the company growing over the next 5, 10, 15 years or so. But on the flip side, you have some investors that don't really care about capital appreciation or stock price increasing. All they want is a company that's consistently paying out dividends, consistently growing the dividends, and they're happy with that. And honestly, that is perfectly fine if that's your strategy. But just keep in mind that you are limiting your potential here, because if you can find a company that not only grows that dividend, but also has potential to grow their share price, your gains will be much more amplified over the long term. Now, I do know that it will be a lot of work to find dividend paying stocks that meet all of these criteria that we talked about here. But when you do find that stock or bunch of stocks, you're going to feel a lot more confident and comfortable putting more money into that stock, even if the stock dips, because you're going to see the other side of that, which is that the dividend yield is going to be even higher. And really, in the end, that's what it comes down to. It comes down to picking good dividend stocks, good investments that you're confident in and that you're going to be investing in regardless of how low the stock price is, because you believe that company is going to be solid over the long term and is going to be consistently increasing their dividends over the long term as well. If you enjoyed this video, a reminder, hit that subscribe button down below and take 2 seconds to drop a like. It helps the channel out tremendously. Either way, guys, thank you so much for watching. Hope this video was insightful for you. Hope you learned something here. But either way, don't forget to invest positively. Peace.